Today, we're going to pull back the curtain on an accounting term that I know sounds a little dry, but trust me, it's one of the most powerful, secret windows into a company's future health. We are talking about deferred revenue.
You've definitely done this, right? You pay for a whole year of a streaming service, maybe a software license. Boom, the company has your cash on day one. But here's the question. Have they actually earned all of it yet?
And the answer is no. In the world of proper accounting, that big upfront payment is not an instant win for the company. It's actually a promise. It's an obligation that they have to you, the customer. Let's dig into how that actually works.
So first, we'll talk about the core idea of this customer promise. Then, we'll literally follow the money as it goes from being a liability to becoming real revenue. We'll also get into some tricky real-world examples, and then we'll wrap up with why this one little number can give you such a powerful peek into a company's future.
Okay, so why the wait? Why can't a company just count all that cash they got as revenue? Well, it all comes down to one really important goal: painting a true and honest picture of how the business is doing over time.
You know, there are basically two ways to look at money. Cash accounting is the simple way. Money comes in, you record it. Money goes out, you record it. But that can give you a really warped view. A company could look incredibly rich in January when everyone buys annual subscriptions and then look like it's totally failing for the next 11 months. That's where accrual accounting comes in. It's the standard for most companies, and it insists that you can only record revenue when you've actually delivered the service. And that brings us right here to our main definition. Deferred revenue is simply cash a company has received for something it hasn't delivered yet. Now here is the most crucial part. This cash is not an asset. On the company's books, on the balance sheet, it's a liability. It's something the company owes.
I absolutely love this way of framing it. That cash you paid them, it's not really their money yet. It's an IOU that the company has written to you, their customer. They owe you a service or a product. It's like a debt of service that they have to pay down month by month.
And this whole idea is built on two foundational rules. The first is the revenue recognition principle, which basically says you can't count your money until you've actually held up your end of the deal. And the second is the matching principle. This one says that any costs you had to get that revenue, like, say, server costs, have to be recorded in the same time period. It's what keeps that financial picture honest and not all lumpy.
All right, so let's get practical. How does this actually happen on the books? How does an accountant physically move that money from the "we owe this" bucket over to the "we earn this" bucket?
It's a really logical three-step dance. So let's stick with our example. You pay $1,200 for a one-year software subscription. Step 1. The company gets your cash, and right away, they create a $1,200 liability called deferred revenue. Step 2. Time passes. 1 month of service is delivered. And then step 3, the company finally gets to earn 1/12 of that money, or $100. And this table just makes it so clear, doesn't it? You see it right there. At the start, the full $1,200 is sitting in the liability column. No earned revenue. Then, at the end of month 1, look what happens. The liability drops to $1,100, and that first $100 magically appears over in the earned revenue column. This just keeps happening, month after month, until that liability is totally gone and all $1,200 has been recognized. And that right there is the whole point. By doing it this way, the company's income statement shows this nice, steady, predictable stream of $100 in revenue each month. That is a way more accurate picture of how their business is actually performing. Okay, so that's the clean, simple theory. But, the real world is almost never that clean and simple. So let's look at a couple of situations where these rules really get put to the test. This is a fantastic one. Think about gift cards. You buy one for a friend. The store gets your cash, and they now have a liability. They owe your friend some merchandise. But what if your friend just forgets about it? Does that money just sit there as a liability forever? Well, not quite. Companies can actually recognize some of that unused balance as revenue. It's a concept called breakage. Based on years of data, they can estimate pretty accurately how much will never be used. Now, a tiny bit might have to be turned over to the state, but as you can see here, a pretty big chunk, in this case 10%, can eventually just become pure profit for the company. Now, to handle all these complex situations, regulators came up with a universal playbook. It's called ASC 606, and really, it's just a 5-step model to make sure everybody's playing by the same fair rules. It forces companies to identify the contract, identify every single promise inside of it, figure out the price, split that price up among all the promises, and then, this is the most important part, only recognize the revenue for each promise as it's actually fulfilled. And having this strict process helps companies avoid some really common traps.
People used to get into big trouble for trying to pull revenue forward to make a quarter look good, or they treat a super complex contract like it was just one simple thing. This new rulebook, ASC 606, it just makes those kinds of accounting games a lot harder to play.
So, we've covered the what and the how. Now it's time for the most important part, the so what. Why should anyone who isn't an accountant actually care about this stuff? Well, it's because deferred revenue is a really powerful signal. It's like looking into a pipeline of future revenue that's already been sold. And a lot of savvy analysts look at an even bigger number, RPO, which stands for Remaining Performance Obligations. RPO includes all of the deferred revenue, plus any revenue that's been contracted but hasn't even been billed yet. It gives you the absolute most complete picture of a company's future sales.
And the scale we're talking about here can be absolutely mind-blowing. A company like Salesforce, which is a giant in the subscription software world, can have an RPO of over $100 billion. That is a massive, legally contracted backlog of revenue they know is coming in over the next few years. Talk about stability. And this, right here, is the golden nugget for any investor. When you're looking at a company's balance sheet and you see that deferred revenue number growing fast, that is a huge leading indicator. It's telling you that sales are strong right now and that all this new business is going to turn into real earned revenue in the next few quarters.
So you see, a growing deferred revenue balance isn't just some boring accounting entry. No way. It's a real quantitative measure of success. It proves that customers are locking in for the long term, and it proves that the sales team is firing on all cylinders. It is a sign of a very healthy, very predictable business.
And that really leaves us with one final thought. You know, a company's income statement, that tells you where it's been. But deferred revenue, that tells you where it's going. So the next time you look at a financial report, don't just look at the sales they already made. Look for the promise of what's still to come.